Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. We're doing a series on college planning, how to pay for college. And last week, where I left off, I'll pick up this week in a different area. A couple of weeks ago, I mentioned EE savings bonds as one sort of resource that has a potential tax benefit. And the way that works, I brought some articles in that I share with you. And you know, when I go through the show, I try to compile a lot of resources to share with you so you can go and get additional information on your own also. So I went to the U.S. Department of the Treasury, and I also went to a number of other resources, but the U.S. Department of the Treasury has some information on its site, and they also have, I'm holding it up for those of you who could see it on TV. It'll be hard for you to see, but it's a report that's available and you can print it out. It's called the Guide to Cashing Savings Bonds. And typically for college, we're talking about EE and I bonds bought within a certain period of time. So here's how it works. Education Savings Bond Program. Has anybody even ever heard of that? I know of nobody who has heard of the Education Savings Bond Program. I know people know of savings bonds, E bonds, EE bonds, H bonds, HH bonds, and I bonds, which are inflation bonds. But I never heard anybody referred, even in the financial planning community, refer to anything called Education Savings Bond Program. So this is news for probably all of us, even though it's existed for a long time. We've known in the financial planning community that since 1989, well, we really knew about it in the early 90s, but since 1989, certain bonds that are issued, if they later are redeemed in the year to pay for college expenses, that the interest earned on those bonds, which would otherwise then be taxable, will be forgiven, taxes forgiven on those. So you can redeem them tax-free. Who knew? Not many, some do. So here's what it goes on to say, and this is right on their site, the U.S. Department of the Treasury. Question, what is the Education Savings Bond Program? Because some of you, many of you, are holding these bonds right now. And at the same time, cashing in mutual fund accounts or taking loans on your 401ks or taking loans on your home or cashing in other investments to pay for college and not even realizing those savings bonds that are sitting in the drawer might have a little tax window, tax-free forgiveness window if you use them instead. So that's why I put the show on, to share those things with you. But here's the answer. What is the Education Savings Bonds Program? Answer. The Education Savings Bonds Program permits qualified taxpayers to exclude from their gross income all or a portion of the interest earned on the redemption of eligible Series EE and Series I bonds issued after 1989. Folks, that's huge. I'll explain what it means here a little more, but even just what I said sounds pretty good. You must be at least 24 years old before the bond's issue date. They're talking about the owner of the bond, folks. So if I'm a parent older than 24 years, I qualify. It's not the student that has to qualify. Then it says to qualify for this exclusion, the taxpayer, the taxpayer's spouse, or the taxpayer's dependent at certain post-secondary educational institutions must incur tuition and other educational expenses. So what they're saying is, I can do it for me, I can do it for my spouse, I can do it for my children. If they're incurring tuition and other educational expenses, then do what? I can redeem my bond and not pay tax. So that's good. And then we get into persons with incomes above certain thresholds may not be eligible to participate. So we'll get into some of this. What qualifies? One of your questions some of you listeners might have, and some of you viewers, what's an eligible education institution? Is it every school? It says here, post-secondary institutions, including vocational schools, that meet the standards for participation in federal assistance, such as guaranteed student loan programs, qualify for the program. So that's pretty good to know, because vocational schools that qualify for this qualify also. It's not just four-year colleges. Proprietary institutions, such as beautician or secretarial schools, though, generally do not qualify. But check. Next question. What educational expenses qualify? Remember I said tuition and certain educational expenses. What qualifies? Tuition, fees, lab fees, for example, other required college expenses, required for the enrollment of or attendance by the taxpayer or the taxpayer's spouse or dependent at an eligible education institution. Payments to state tuition programs are also eligible. That's good because we covered that last week. However, expenses relating to any course or other education involving sports, games, hobbies are eligible only if required as a part of a degree or certificate granting program. So there's fine print here, folks. You don't have to memorize what I'm saying. You just kind of have to hear it, and then you can research it later. Costs of room and board and books are not eligible expenses. Now that's a big one because we would have thought they were. So we're talking mainly tuition type expenses, but they're saying here and clearly clarifying costs of room and board as well as books are not eligible expenses. And then it says the amount of eligible expenses is reduced by the amount of any scholarships, fellowships, employer-provided educational assistance, and other tuition reduction. Eligible expenses must be incurred during the same tax year in which the eligible bonds are redeemed. So we can't redeem the bonds a year in advance, getting ready. We can't redeem the bonds a year after the expenses are incurred. All right. Are there income limitations? It went on to say, yes, there are, and we'll go through. There's a publication, IRS 550, that goes on to share some of these in details. And there's a lot of details on here. Can all outstanding bonds be used to qualify? No. It applies only to EE and I bonds issued after December 31st, 1989. They can be in paper form or electronic form. They're still seen as valid. Savings bonds issued before that date and other series of bonds like HH are not eligible. Only EE, otherwise referred to as EE, and I bonds issued after December 31st, 1989. So I want you to get I want you to go through here and see, how do we work this? And especially for a grandparent, because you look at this and you say the grandparents have the bonds, but this says to qualify for the exclusion, the taxpayer, that's the owner of the bond, the one with the Social Security number on the bond, the taxpayer's spouse, or the taxpayer's dependent. So we have a little trouble here. Wait a minute. If the grandparents own the bonds, are they allowed to cash in the bonds, pay for the expense? Well, it's gone on here, and it says, can anyone purchase these bonds and take advantage of this? No. To exclude interest earnings on EE and I bonds after 1989, a taxpayer must be at least 24 years old again, before the bond's issue date. Since a bond's issue date is the first day of the month, it goes on to say if they're married, they have to file a joint return. This goes on to say we might have trouble if it's not a dependent that's doing this. So be very, very careful here. If you start buying bonds for education, I'm going to caution you on that anyway, because we don't do investment or savings decisions based on taxes. We don't let taxes direct the cart. We actually control all of our financial decisions using taxes as one of the many variables that we have to consider in making the best decisions. But I did want to share some of this with you. It goes on and on and on in this and in the guide to saving on all these bonds. Buying savings bonds, how to liquidate them, understanding the dates. You know, here's how to not cash the bond. Here's how to do cash the bond. Special cases for parents. I mean, this guide that I'm talking to you about even gets into legal representatives. So I'll hold that up once more. I hope you could see it. But if you don't, it's on the U.S. Department of the Treasury website. It's called the Guide to Cashing Savings Bonds. And it goes on to some interesting cases. Legal representative not named on the bond. What do we do? Can we do it? Individuals identified, et cetera. What documents do you need? So that's pretty good with the savings bonds. I also run into another issue on savings bonds for retirees. So you may have grandparents. Now get this. We have technical issues on whether grandparents or any unrelated person or related person who the student is not their dependent, can they maybe not apply this savings bond tax-free window or of opportunity? But I want you to understand, talk to your grandparents or your parents, which are the grandparents of your dependent, and ask them a question. They're probably not going to answer it because they're going to say it's none of your business. But ask the question. And for those of you grandparents listening, ask yourselves this question. Do we pay taxes? If you're only on Social Security or have low income otherwise that you draw, you may have high assets, you just don't take any money out. You may have low income taxes. You may not pay income taxes. You may get a refund of everything that's withheld every year. You may not even have to file a return. So for those of you grandparents in this example, it's not always grandparents. It could be someone on disability that's only on Social Security and disability and is low tax bracket because a lot of the Social Security might not be taxable. A lot of your disability income payments might not be taxable for that matter. Some are, some aren't. If you find yourselves in that situation, you may find you're able to take additional income. Even if you had additional income, you wouldn't owe tax up to a certain level. I run into this all the time. All the time doesn't mean every day, but I'll bet I run into it a couple times a month with different people that I talk to and different clients, where you look at the tax return. Well, I look at the tax return and I say, you're under the limit of having to pay any taxes. They say, yeah. And I say, do you realize what that means? No, we all don't pay taxes. And I say, that means if you took additional otherwise taxable income that would have been taxable out of an investment account, not saying go to work, although sometimes you can, but sometimes you can't. If you're on disability, if you're on Social Security, you go to work, it messes up the disability or Social Security. So we don't let taxes run our decisions, remember. But let's take this situation. We have some investment accounts or an IRA or these savings bonds, which we're afraid to cash because they'll be taxed. And here we find on the tax return that if we cash in some of these savings bonds, we can't apply this college tax-free strategy because they're not your dependent, let's say, which sometimes we probably could even do that. But let's say we can't, and you still want to help this grandchild, or you still want to help this niece or nephew, or even a neighbor. If your own tax situation is such that you could liquidate some more taxable income and you still won't owe tax until you exceed a certain limit, your standard deduction and personal exemption offset another $5,000 of taxable income if you had it from somewhere. Then couldn't you cash in $5,000 worth of taxable interest, double E bonds, double H bonds, which don't qualify for the college credit, that would otherwise be taxable as long as you don't exceed that limit? Aren't they tax-free anyway? I mean, tax-free is tax-free. And if it's then tax-free, can't you then give it to the parent or to the student and pay the tuition? I know you can expand on that in your own minds on, wait a minute, if we did that, then we could do this. That opens a whole door of planning opportunities. We're in a high income tax bracket, the parents might say. My parents are in a low income tax bracket, they might say. Let's swap, let's switch, let's cross generations. I call it cross-generational financial planning, cross-generational or multi-generation estate planning and financial planning and tax planning. Folks, it's huge. I've brought it up in other shows before. We could transfer tax losses from generation to generation, capture gifting, capture all of those things, step up in basis, step down in basis, all those things. It all comes into play. I'm talking about college today, and here I'm off with tax planning, and then I'm off with multi-generation planning. But look at how sophisticated and simple it can be at the same time. Parents cash in $5,000, double E bonds, they don't pay tax. You inherit those bonds? You do. So they say, hey, we'll cash them now, they're tax-free, we'll figure out our money some other way, and we don't need these college double E bonds. We'll pull it out of an IRA. We'll pull it out. We don't pay tax up to a certain limit. I've talked to you about other shows in many of these tax strategies, and that can apply for helping maximize college funding, because you as parents might have to cash in $7,000 or $6,000 of taxable assets to get $5,000 to the university. Your parents are getting help from someone else who's in a better tax situation, might only have to liquidate $5,000 of holdings to get $5,000 to the university. So huge planning opportunities and big, big tax breaks. So that's basically how the Double E Savings Bond Plan works. And I wanted to get into that for you. Now, we get into some other strategies, and it has a double purpose. So you get into, I won't go into the big areas we'll cover next, are probably back into the UGMA and UTMA and the kiddie tax next week. I won't get into that today because I want to cover that in some detail for you. But there are ways and strategies that you can open up accounts for proposed and future college students that if the funds are held in their name up to certain limits, they're taxed at their bracket, which is zero. So you can accumulate assets, not having to be in a college type investment, but it does have to be in a minor account. And that's where we talked last week about UTMA and UGMAs. I want to share with you probably next week the tax benefits and drawbacks in those types of programs. When we talk about state programs, I'll also go into 529s, but again, that's too much for today. The last thing I'll touch on today are, I guess, satellite type programs like uPromise. You see that, and you see the uPromise type programs, and you'll see some other names, Sage, S-A-G-E. You'll see some other things, and I shared that with you last week, a little bit about those unique programs. But the key is, again, to ask the same questions. Are we guaranteeing what we put in there? And it's okay if we're not. We just want to find out in advance. Are we guaranteeing that the money that's in there is buying credits? Are we inflation proof? Or are we still subject to inflation? And if we are, why would we do it? Well, one of Upromise's answers would be, Upromise is, and it's upromise.com. I shared that with you last week. That's U, the letter U, promise.com. One of their responses would be, yes, but if you go to all the different retailers around, the part of your purchase can get applied toward funding into this account. So there are benefits there. But they might say, no, it's not guaranteed. No, it's not guaranteed growth. No, the funds aren't guaranteed. Yes, they are. You need to find out. You know, obviously you want to find out that by yourself. Are there limits? Are there income limits? Things like that. But the Upromise account, what we want to do is we want to make sure that you understand with Upromise who's issuing that. Is it a state agency? Is it a private agency? Is it investment funds? Are they savings accounts? Do they pay specific rates of interest? What happens if the student doesn't go to college? Can it repay student loans? I have all those answers here. I'll share them with you probably on another show. There's not enough time today. But these are your questions for any type of program that you're looking into. You want to be asking these types of programs. All right. Folks, we're out of time again. It's a fun topic to discuss if we're dealing with it in advance. It's a nightmarish topic to discuss if you waited till the last minute and now you're trying to finance college education because you either waited too long or didn't have access to a program or a financial planner such as myself well enough versed in these areas to help you out and soften the blow. So again, I implore you to call my office. I'll help you through this maze if you want. I'll get you access to information or we can get together. I appreciate you tuning in to another edition of All Things Financial, and I'll be back again next week.
Securities and investment advisory services offered through SagePoint Financial Inc., member FINRA SIPC, and registered investment advisor. Insurance services offered through Driscoll Insurance and Financial Services Inc., which is not affiliated with SagePoint Financial Inc.